Hello everyone and welcome to At Barrons. I'm Andy Serwer and welcome to our guest Olaolu Aganga, Chief U.S. Investment Officer at Mercer. Olaolu, nice to see you.
Thank you for having me, Andy.
So why don't we start off by you telling us a little bit about Mercer and specifically your role there.
I'm going to give a bit of a history lesson because I like those.
Good.
So Mercer was founded in 1945 by William M. Mercer, founded in Canada, really focused on actuarial and benefits. In 1959 got acquired by Marsh McLennan. So Marsh McLennan has two lines of businesses, risk, then insurance services, and then consulting, just broader consulting, which is where Mercer is. So at Mercer we have health, wealth, career. I'm in the investments business. We have, call it maybe $420 billion under management from a discretionary standpoint, 16 trillion under advisement. And our clients range from defined benefit pension plans, defined contribution, not-for-profit, wealth management, insurance, as well healthcare. And our focus really is on delivering on the investment promise that we make to our clients. So either to retire with dignity, like I say, or really growing the pools for these clients to have the most impact in society.
Right, so part of Marsh, which is a publicly traded company, and then you have money directly under management as well as advising clients with their own portfolios, right?
Correct.
Okay,
Correct.
and so specifically, Olaolu, what is your purview? Are you an asset allocator? Do you manage money personally? Tell us about your roles.
Yes, so as the Chief Investment Officer, I oversee both parts of the business. So the assets under management, the $420 billion, and then also the assets under advisement. So our goal is really to be able to do the asset allocation, the manager selection, and we're allocators and fiduciaries and stewards of capital.
And as far as the other parts of Mercer or even Marsh McLennan, do they come into play with what you do? Do you work with other parts of the business?
Very much so, very much so. So as I said, we have two lines of businesses, so risk, insurance, very, very complementary businesses. One is stable, cash flowing, growing. We do a number of services for large corporations and other types of clients. And then for the regular consulting business, management consulting, the insights that we get from those, we use in our client portfolios all the time. So the health and the career businesses, for example, those studies that we issue and do are very, very impactful in our portfolios and our thought process.
What's your pitch to clients? How do you guys see yourselves differentiated from your competitors?
We are a unique firm. As I mentioned, our DNA is consulting, and that is, I think, frankly, what's helped us grow the way we are. We don't have products like you would think for a traditional asset management firm, and that has helped us talk to clients in a way that they can take the advice and recommendations that we are giving them and not think that we are trying to profit from it. We don't have ETFs, for example, or any of those types of securities. And as a result of that, when we are allocating or giving a recommendation or saying that a client would benefit from moving into a particular type of asset class or investment, they trust what we are saying. And that's a really big appeal for our clients and our prospects.
So let's shift over into your perspective on things. And what is your take on the markets right now, or maybe the macro environment writ large?
We are really in a very complicated time. We're emerging from one. It was actually even more complicated not too long ago, coming off of the pandemic. Prior to the pandemic, we had rates at zero. Equity markets were at all-time highs. Then you had a global pandemic, and inflation was a word people didn't even say in many, many years. We had the Fed raise rates in order to be able to combat that, and that's what we're sitting in front of right now. But from a macroeconomic standpoint and markets perspective, we have a number of things at play. So if you are trying to get a mortgage, if you're trying to get a loan, rates are incredibly high. So it's been affecting the growth of some of those areas. But then, as I mentioned, we're coming off a pandemic. So we have hybrid work. And where you would think perhaps there could be higher unemployment, there isn't. So there are different types of work that is allowing the environment and GDP and macro data to still be strong in the middle of everything that we're seeing. We do know that it's not sustainable. And Mercer's view has been, and still is, that we expect rate cuts, not to the same level that some firms did. Like when we started the year, I think there were many firms that were calling for hikes in March, rate cuts in March, and now we've always been calling for it maybe mid-year, maybe later in the year, to be able to get to a more sustainable level and really pick back on economic growth.
It's funny, everything's gotten so attenuated. The recession's further and further out. The rate cuts are further and further out. I mean, is this what we're calling sort of a continuous landing at this point?
It hard landing, soft landing, continuous landing, yes, it gets pushed out. It gets pushed out. And it's data dependent, and that's what the Fed says themselves. So they've really now moved to a situation whereby as the data comes out, you look and you analyze and you see the impacts of the environment and see if you can move it out. It gets pushed out continuously. And then in the US, of course, towards the ending of the year, we have a big election.
Right.
So it's a focus.
And so do you see rate cuts this year then, or how many rate cuts? What is your take on that? Are you in the higher, longer camp, or?
It is higher, longer, but we still expect rate cuts. So we're calling for rate cuts, perhaps June or later. So that's our view. Still data dependent, because as the data comes out, if it's continuously stronger, then that delays it. But we see rate cuts happening this year.
Even with the election complicating matters?
I mean, the Fed is election agnostic, and geopolitics has always been prevalent. The studies that we have done, I mentioned Mercer being a consulting firm where we look at these things, we've seen that elections themselves don't have long-lasting impact on markets. Frankly, it's the policies that happen afterwards that have a more predominant effect. But from a Fed standpoint, of rate hikes or rate cuts, it's agnostic from an election cycle.
Let me ask you about equities, strictly speaking. And obviously all the talk is the Mag 7, Magnificent 7, NVIDIA, AI, tech stocks, the overweight there. How do you think about that, and how do you manage money and advise clients based on what's going on there?
Andy, I'm not going to lie to you, it's hard. It is very hard, because when you pay a manager, they're not supposed to invest in the things that you can invest in passively by yourself. The concentration of these names in the index is frankly what is troubling for a lot of investors, myself included, because the narrow breadth means that as you search for opportunities, the opportunities could be good, but those opportunities they pale in comparison to these small handful of names. So the index construction and the weights in the indices is really, frankly, what's causing a little bit more of the concern, more than I've ever seen.
So are you able to deploy money there, or do you feel comfortable doing that? Or, I mean, you can see things. I think what you're saying is you see this opportunity to say there's value, but it doesn't work, right? Because all the money is getting sucked up by those names, right?
Well, our recommendation for clients, if you're investing in U.S. equities, large cap is passive. So there are other areas where active management would make more of a difference and more of an impact. The opportunity set, the ability to make money is so difficult in U.S. large cap equities that passive is our recommendation. And then internationally, active management there within fixed income, there are a lot of opportunities, clearly with rates being where they are. You don't have to take as much risk to be able to get that yield, and you start looking for pockets of opportunities also within private markets. So there's a lot more beyond the Magnificent Seven.
I want to drill down into some of those things you talked about. At some point, things will broaden out or change. And I understand you're kind of keen on infrastructure being an opportunity. How does that work?
Keen on infrastructure. Infrastructure is a long hold asset, and it's always been a long hold asset. But I think finally we are seeing real dollars being allocated, trillions of dollars in the U.S. going to states for bridges, tunnels, development. There is digital infrastructure, there's urbanization, development, frankly, of roads that haven't been developed in a very, very long time. We are seeing the dollars moving in the last couple of years, frankly, that have been announced. And that is an opportunity to have a real impact, both from a profitability standpoint, and companies that are associated with that as well. And from a development, broader good.
And so the investing opportunities are public equities, privates, and then just the add-on effect that spurs economic development in those geographic areas?
Yeah, where we're seeing really a lot of the opportunity, there's still tech, right? Because tech and AI and that type of development is critical, and it spurs innovation. Then within private markets, we recommend a broadly diversified set of allocations. So private equity is still the cornerstone of a private markets portfolio. Can't forget that. Infrastructure and real estate. Real estate has had a somewhat challenging time with rates where they are. But as the rate cuts rather continue and come into play, we see that being more in favor, call it 25.
Olaolu, I want to ask you about privates because there's been more and more allocation for institutions getting in there, and now, of course, retail investors are being pitched.
Yep.
Is that a problem? Is that too much risk or misunderstood risk?
The good thing about private markets is it requires a lot of paperwork in order for you to invest. So you have to be an accredited investor, there have to be profile checks, those types of things. So suitability is critical. And even for the institutional clients that we talk to, we make sure, as we're talking through their objectives, their returns, their tolerance for illiquidity, is it suitable for you? And that's the first gating item. Then the next one becomes how much? How much and which kinds? So the profile of the investor and their needs is where we're spending a lot of time before any type of recommendation.
What about diversification? Does that still work, and allocations between equities and fixed income? How has that changed?
In the last few years, we have seen the diversifying properties of between equities and bonds go down. 2022, both down in the same direction as we saw. 2023, they were both up. Correlation, so just for the U.S. aggregate, which has a 7-year term, between that and bonds is actually, it's actually a little bit positive, like slightly positive. It's negative for longer term fixed income. But what we've seen, because we have significantly lower diversification properties than we had historically, we are looking to broaden out into a number of different strategies. So something that has been out of favor for some time during a specific period, hedge fund strategies. If you construct a portfolio of a well-constructed portfolio of hedge fund strategies to remove the market beta, you can have the same type of diversification properties that you're looking for. And diversification is insurance when you need it. So hedge fund strategies can generate return, but still have a diversified risk profile to both equities and bonds, actually.
Yeah, I think you were talking about insurance and that we all have insurance in our portfolios in one way or the other. What did you mean by that exactly then?
That is, if a well-constructed hedge fund portfolio should have either been flat, right, so relatively stable, or positive in 2022 when equities and bonds went down because of that type of diversification. So it mitigates the overall drawdown in your portfolio. You usually, everyone should have some sort of insurance. Pays off when you need it. That's the same way you look at investing. So you can have the parts of your portfolio that are by design meant to go up, but then they have higher volatility, so when they go down it could hurt. But then you look at your insurance and know that that's always a buffer.
You went to business school and you studied markets, the history of markets. Are there any times that you can look to that are instructive in terms of what's going on now? Sometimes it seems that things are so singular these days.
I may argue that they've always been singular, right? If you go back through all the different types of crisis that we had, 2008, it's a credit-related crisis. Then when we moved forward with that, who would have predicted the pandemic that came after that? And going back to the early 2000s, the tech bubble, they were all different. Everything was different. You know, some commonalities in there could have been some aspect of maybe leverage or easy credit in some way, shape, or form as you were going through, not the pandemic, of course. But they're all slightly different. And it happens. What we're finding now is it's happening maybe a little bit more than they used to. So every call it 7 years. We're not calling for another one, but we've seen that, and the goal, back to the fact of having insurance in your portfolio, means that when the drawdowns happen, you know you have something built in.
Do you have faith in the Fed?
I think we all have to.
Right.
I think we all have to, because at the end of the day, as you think of the direction of rates, like that one number is the driving force in the entire economy. That's what everyone is looking at. That's what everyone is focused on. It determines mortgage rates. It determines lending rates. We all have to.
One thing that is new in the investing world is crypto. And I wonder how your thinking has evolved, or has it?
Cryptocurrency in institutional portfolios, just if you were to look at the data, is rare / perhaps not really existent right now. It's an asset class that we watch like everything else. Of course, there was legislation that just went through maybe a couple of weeks ago. You're starting to see crypto ETFs and those types of things. But for us, recommending them for clients and inclusion in portfolios is not where we are at this stage.
Okay. And final question, Olaolu. And when you were growing up, did you envision yourself in this job? Did you want to be an institutional investor when you grew up? Tell us about your story and how you got to this role.
I am cracking up because I don't even know if I could spell what that was. I was born in Nigeria. My family moved to Botswana when I was 7, just looking for opportunities like anybody else. And we lived in a town 30 minutes from the border, right above South Africa. What I knew of America, I saw on TV. It was a dream. It was a dream that I did not know was possible. But a series of events. I went to college in Massachusetts, and from there I got a job in New York over 20 years ago. And fast forward many a year, here I am today. I did not see this coming at all, but I would say just looking at the opportunities available in this country, I am just so incredibly proud of the fact that those types of opportunities are possible.
And follow-up question. So, but what made you choose finance as opposed to politics or sports or the arts or something else?
So I majored in math when I was in college.
Smith College.
I went to Smith College, Northampton, Massachusetts. I majored in math, and it was like puzzles for me. And I was looking for opportunities where the numbers could come alive. I worked with my college professors. I was looking at academia. But that was not nearly as exciting as numbers coming alive in the world of finance. So it was almost by accident, just talking to folks and seeing where I could use that degree. And I also had family that was in New York. My older brother went to medical school here. And then from there, I got a job and just didn't look back.
Olaolu Aganga, Chief U.S. Investment Officer at Mercer. Thank you so much for joining us.
Thank you, Andy.
This is at Barrons. I'm Andy Serwer. We'll catch you next time.